Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to a new episode of A Canadian Investing in the U.S. with Glen Sutherland. This week, my guest is Neal Bawa. Neal, you want to just first off give everybody a bit of an introduction to yourself so they know a little bit about you?
Sure. I'm a reformed or recovering technologist, computer science degree, data science is my background. Ran a tech company, sold it in 2013, had a massive tax bill, bought apartment complexes to make sure that I didn't pay millions of dollars in taxes, and eventually sort of got suckered into becoming a full-time real estate guy by 2014. So 11 years in real estate, 1,300 accredited investors. The portfolio shrinks in size or goes up in size from time to time. Currently about 660 million, about 30 plus projects. Half of them are new construction projects that we've built. We're not actually currently building a lot. We're mostly leasing up at the current time, late in the cycle. And the rest are basically multifamily, self-storage, and other asset classes. Most of our investors are pretty nerdy, geeky, so interested in data. We publish a massive amount of data that about 40 to 50,000 people use.
That's incredible. Oh, wow. So we have so much to talk about, and I honestly we didn't like all my podcasts. I don't really plan it, but I was looking at your one sheet, and I saw that you became financially free by investing in apartment buildings, student housing, storage units, industrial buildings, and fourplexes. And honestly, it's one of those things that anytime I hear about somebody doing the bigger stuff and the little stuff and a little bit of all this different things, there's so many different reasons. Like even myself, like I syndicate deals, but I also do single family and fourplexes as well. And I think everybody has different reasons to do all these different things. And maybe you could touch on that a little bit, like why so many different asset classes.
I think the first reason, the straightforward reason, is supply. So from time to time, any good asset class will get saturated. There'll be too much supply. There'll be, too little demand. Or you might say there's overwhelming demand, but the supply is even higher than that. So it makes sense to look at other different markets. The second reason is to learn, right? So you learn when you try different asset classes, you learn whether the one that you had was better or worse. How do they compare with each other? So I think doing multiple asset classes gives you a wider perspective, and it's something that your investors like. And third, sometimes the investors push you into it. They're like, well, we've heard about student housing. Why aren't you doing industrial? Why aren't you doing self-storage? And fourth, we publish data on all CRE asset classes. We publish data on office, multifamily, retail, self-storage, senior housing, student housing, and industrial. And so because these 7 sort of big sectors, we publish data on them. You meet interesting people in each segment from time to time through your data publishing, and you find good partners. So the projects that we've done for industrial have been with a partner, and they've been in that partner's metro. And we learned a lot. We learned a lot about how industrial is different, by doing that partnership. The projects that we've done with student housing have also been in partnership with a student housing person who basically builds student housing at certain specific universities, very small numbers of universities. They're focused in that market. So again, a great chance to learn from people that were incredible. And so I think it really comes down to either working with amazing partners or wanting to learn or wanting to basically jump into something that is not as saturated as whatever it is that you're doing, right? So multifamily, for example, was highly saturated for the last 2 years and still is in many metros in the US for the next 6 months. And that gave us a chance to dabble and look at what else are cap rates not increasing it? What else is not seeing overwhelming supply? What else is seeing rent growth? And I think the answers to all of those were the asset classes you just mentioned.
That's awesome. And you said like right now you're working on mostly leasing up. So does that mean you've already, closed on the properties, you've got the properties, and now it's just getting them all running? Or I guess some of it was ground up development too. Like what kind of projects was it that you started with that you're now leasing up?
We have a 240 unit Class A property that is ending lease up in Phoenix. We have a 320 unit property in Phoenix that is starting lease up. So it's built, but it's starting lease up. We have a 93 unit townhome property that is a third of the way through lease up. We have a 127 unit property that is starting lease up. We don't actually have any projects that are like starting construction or in mid construction. So we're very sort of late in the cycle where we're mostly doing lease ups on the development side. We have a 200,000 square foot industrial building that we just finished the lease up for. So we just signed the last lease a few weeks ago. Now it's at 100% occupancy. So late in the cycle, lease up obviously is the key. And then our apartment complexes that we're holding, which are sort of older, projects, we have them in many different parts of the US. We're just simply focused on occupancy. Right now, we don't have a focus on rent growth. Our focus is on maintaining occupancy north of 90% in all of our properties. So all of them are currently between 90 and 97%. We have one that's a straggler in the market that has a huge amount of supply. So we're very focused on that one.
That makes a lot of sense. And so going back to where at the start 2 years, you were saying supply is changing. And if you were somebody who didn't have any properties or was looking to, start investing in the US or start, going into this, are you finding that there's an opportunity in a certain type of asset class or in a certain market right now? Are you looking to invest in the US? Are you looking for a coach that has been doing this for much more than 1 year? In fact, doing this for almost 10 years? Do you want to do one-on-one calls? Do you want to actually have someone looking at your deals and actually thinking and worrying about your projects? If that's of interest to you, I'd love to get on a phone call with you. Go to glensutherland.com or at CanadianInvestingInTheUSA.com and schedule a call. And we'll just do a quick 15 minutes to see if it works for you.
I think the answer to that, there's only one right answer. The answer is yes. I mean, the United States is 323 metros. We have 337 million people living in this country. It's a huge country with a massive number of metros and also a massive number of asset classes. So the only possible answer to your question is yes. But I have to say that this is late in the cycle in general for real estate. A new cycle is beginning, which is nice, but we're still, sort of in many metros still on the last part of the old cycle and haven't started a new cycle yet. And I'll explain why that new cycle would start and when. And because of that, there's less opportunity today than there was, let's say, in 2018 or 2019 when we were still earlier in the cycle. So one has to look for pockets. And the biggest opportunity that I see going forward is that many of these 323 metros that we just mentioned are going to run out of supply. And this will has started happening in some metros. Kansas City, perfect example. It will happen in some metros in 6 months. Idaho Falls, perfect example. And then it'll happen in other metros in 12 to 18 months. Phoenix or Austin, another example. So what we have is we had a massive glut of supply in just about every single market in the US that I can name. There were a few exceptions to that. Chicago didn't see a glut. Cincinnati, Cleveland did not see a glut. But Kansas City was okay. The vast majority of cities in the US saw a glut of supply, and that supply came in somewhere between 2022 and now. And some markets, it continues to come in over the next 12 months. But it would be very difficult for me to find a market in the United States that 18 months from now still is facing supply more than demand. So we are going to be in a situation 18 months from today where it will be hard to find metros in the US where the demand is lower than the supply. And that inevitably will start a new real estate cycle where and the sort of cycle that we had for 10 years before the last 2 or 3 years where supply was higher than demand. And so we've had, if I look at the last 11 or 12 years, we've never had supply higher than demand with the exception of the last 2 or 3 years. The last two or 3 years, so we've been on that down part, the bearish portion of the cycle. And depending on the city, the bullish part of the cycle starts now, 6 months from now, 12 months from now, or 18 months from now.
Is there an easy indicator to know when that cycle has changed? Is it that you're going to see that the prices are like maybe at asking or over asking? Is there going to be any or something completely different? Is there going to be some sort of indicator? Did you know that there are more lending scams in the United States than anywhere else? I've actually come across many of them myself, and some of them are very good at looking legit. if you're interested in a list of lenders, please go to my website and get a list of verified lenders at CanadianInvestingInTheUSA.com/lenders. That, people
I think
be
the
like, hey, the
easiest
market's changed.
indicator, yeah. So I'll answer the question from the perspective of professionals, like senior professionals, down to somebody that hasn't even started in the industry, right? If you're a senior professional, hopefully you are subscribing to at least one of CoStar, Yardi, and RealPage. Each of these provide indicators for each submarket in the U.S. Of supply versus demand, right? So they're providing those indicators, and we're looking at those indicators constantly for these various products. So I think the every senior professional would simply say, yeah, I know what he's talking about because I'm looking at the submarkets and I'm seeing, okay, well, there was 800 units of supply that came in the last year in this submarket. Now there's only 93 units left. In the next 12 months, I don't see anything. So I know what he's talking about. I know at some point, demand will be higher than supply. Now, if you are not one of those senior executives, you don't subscribe to this particular software, one other indicator that you can get generally is by looking at concessions. So we pay for Hello Data, which is a much less expensive software than CoStar, Yardi, or RealPage. So you're paying a few $100s a month, and Hello Data gives you concession information for any building that you want. So if you're looking at, South San Antonio, go in there, find a building, plug it in, and Hello Data will give you concessions data. One of the best ways to know if a market's glut has ended is to look at all of the concessions listings that Hello Data gives you and make sure none of them say more than 4 weeks. 4 weeks is actually pretty normal for new construction, but recently we've seen 6 weeks, 8 weeks, and 10 weeks in the US. So if you start seeing 4 weeks, the market has returned to normal. At some point, you're going to see 2 weeks, at which point those buildings that are coming in at that point are going to lease up like lightning. But I haven't seen any market in the U.S. at this point being at 2 weeks. So we're not there yet. We're not at that point of the cycle yet. So now you're paying $250. Now what about people that don't have $250 a month to pay? Well, the simple answer is this: if rents are going higher, and then ask ChatGPT, how do I basically track rents for a particular submarket? If rents are increasing by more than 2%, the market flattens out. Because inflation in the US is 3%. Therefore, rents in the US should be growing at 3%. If they're growing faster than 2%, then they're on track for that 3%. And it's sort of a leading indicator, so it takes a little bit of time to catch up to inflation. So if you're above 2% rent growth for, let's say, the last 3 months, your market's flattened out and is now going in the right direction. So hopefully, senior professional, junior professional, anybody that basically has access to ChatGPT can figure this out.
Yeah, no, I do that with my ChatGPT all the time, just to check that for the residential stuff, and then I'd use Crexy for the more commercial stuff. That's awesome, Neil. Those are awesome tips. I think everyone can take something from that one. For people who are like, hey, Neil, I love what you're saying. You want to tell people about your show, what other things, where people find you?
Yeah, I think what we found is that there's a large number of excellent podcasts in the US. We don't want to add to that list. Apple can recommend lots of them. I recommend Glen's podcast. And I think, so we didn't want to add to that. What we decided to do was something very different. A podcast is a conversation, and it's fun and interesting to listen to. What we decided to do was we were going to do webinars. So what we do is we do about 8 to 10 webinars a year. And these webinars are data-driven, 50 slides, very, very high quality, imagine movie level production. And we do these for free to our both our investors and our ecosystem. We have about 1,300 investors. They come in. And then we've got the ecosystem itself. People come in from, we have about 70,000 people in our database. So about 20,000 of them sign up for our webinars. And they're at Multifamily University. So if you go to multifamilyu.com, that's probably the best way to engage in our ecosystem and share in the information. For example, our next webinar that's coming up is October 22nd, and it is about artificial intelligence and what that means for real estate. So AI, data centers, and what it means for real estate. And we also do meetups, but we usually do them just in the San Francisco Bay Area where I live. And so that's the way to get in touch with me. I can tell you that if you spell my name right, the first 5,000 links that are on Google are all about me, so you're going to learn a lot.
Awesome. Neil, this is a great conversation. I think people got a lot of takeaways from it. I do really appreciate it, and I know you're a really busy guy. Thank you so much for coming on the show.
Thanks for having me on the show. Bye-bye.
That was a nice video. Bye.